And then I'm going to get this started. If you keep letting everybody in. Looking forward to a great session today. Thank you, everybody, for joining us. This is our monthly and late end of the month CEO Forum Presenter Series. And today we have Jay Denton with LaborIQ visiting us to talk us through the 2023 labor market outlook. And some of you may recall Jay was with us earlier this year. I think it was earlier this year, maybe it was last year. Seems like just yesterday. So anybody who just joined, if you wouldn't mind just putting into the chat your name, your company, who you are, where you're located and what your company does, that would be awesome. And then also if you can mute if you're not talking until we get to the Q&A part. And anytime today when Jay's walking us through his presentation, feel free to put any questions in the chat. He'll be stopping from time to time to answer those. And we'll also have a Q&A at the end. So you'll have plenty of opportunity to address any questions. And then we're also, as I mentioned, recording this, so we'll upload this to the e-forum for later viewing. Before I introduce Jay, I'll go through our usual 5 bullets of our meeting rules, and there we call them the 5 C's. We are confidential. What's discussed here stays here. We're collaborative because we engage. It's not a spectator sport. Contextual, we have no selling, no politics, and nothing's personal. We're always cordial. We're helpful, supportive, and we share the time here together. And we're committed not only to yourself and to your peers. So we ask that you can limit distractions as much as possible. If you have to go off screen, that's not a problem. Just make sure you mute yourself. And mute yourself now too if you're not talking. With that, I think I'd like to introduce Jay and give a little background on him. Jay Denton serves as the Chief Analytics Officer for LaborIQ, a compensation recommendation platform. He's charged with leading the product data and market analysis business units. His expertise in analyzing and distilling complex data into actionable insights supplies the HR and recruiting industries with why it matters. And he answers for and gives them the why it matters answers for strategic business and talent decisions. Before joining LaborIQ, Jay was involved in the multifamily industry, serving as the SVP of research for one of the nation's most successful apartment investment management companies. He's assisted in raising an investment fund of just under $1 billion, as well as leading the team that created their business intelligence platform. Prior to that, Jay was founding senior member of a software company that specialized in real estate research, which was acquired by a publicly traded company. He has been featured in Bloomberg Business, the Wall Street Journal, New York Post, Business Insider, and many others. He's sought after speaker for executive groups, talent acquisition associations, and media outlets across the country. He holds dual degrees in management information systems and general business from Texas Tech's Rawls College of Business. And there's probably a lot more on Jay. I probably find him on CNN some morning, but he's always on LinkedIn. So if you aren't following him, look him up on LinkedIn. We'll provide his link later. Every day, it seems there's something great that he's sharing and is useful to you and what you're doing at your companies. But with that, I'd like to thank Jay for being here and welcome him and turn the meeting over to him. It's all yours.
All right, Laura, thank you for that introduction. By the way, as part of that journey, I was at a company called RealPage, and I see one of my former colleagues, Joanna Hackney, on the call today. So,
yep, great to see you, Jay.
Yes, you as well. All right, let's go ahead and get started. Plenty of material to cover today, as you might imagine, because the labor market, the economy has had all sorts of changes, and so we will cover that today. I'll tell you, there's good news, there's bad news, there's everything in between. I'll try to be fair and balanced with all of those points. Now, before I completely launch into the presentation, just to give you an idea of, so here at LaborIQ, what we really specialize in is the compensation space. And so we help companies, all sorts of industries, figure out where salaries are today to actually land a candidate or retain a candidate. This is the main part of what we do within our platform. But to do that, we're very labor market focused. So I'm going to be giving you the insights that we use, that we put into the system about what's happening in the economy, the labor market, and then obviously compensation will be part of the discussion. So Laura, thank you for the intro. Yeah, if you do want to follow, and I'll show the link right after this, Laura will share it later, but we post the articles we're featured in, whether it's Bloomberg, Business Insider, all sorts of others. My post today, really cool, was featured as one of LinkedIn's top 10 posts of the day. All I did was simply recap a Wall Street Journal article. Honestly, I didn't do that much to it, but that was really nice of them to feature it. So if you'd like to follow me, one of my colleagues, or the company, this will be in the deck that you will get after. So don't feel like you have to screenshot all of this or anything, you'll get this full deck following the presentation. So here we go. Here is today's agenda. So we'll talk about these topics. In between each section, I will stop and pause and check anything that's in the chat box or the Q&A and see any questions that you have along the way. At the very end, we'll then pause a second at the end and answer any additional questions you have. So without further ado, let's get this thing kicked off. So we're going to start off with the puzzling labor market that you all in your roles, I'm sure, as you're figuring out from an operations standpoint, whether it's production levels or budgets or any of that, like news has been on either side of the equation from really good to really bad. So we started about 9 months ago, kind of early summer last year, starting to just capture some of these headlines around, gosh, it seems like we get a really good number and we start making business decisions based on that. And then something just as bad as that was good comes out. So here's a sample, by the way, since about mid last summer, some of the things that we've been going through. So there were recession fears even back last summer, but then we got phenomenal job growth. But then the economy, a report comes out, it's weaker than we thought. In fact, but it's almost too strong for its own good. We have something happening on the other side of the world with Russia and Saudi Arabia that starts having some good, some bad impacts here. Don't worry though, we're going to bring all our manufacturing and chips and all that back over here to the US. But as we do that, our people, our employees, they're fighting the inflation, trying to figure out how they balance their own budgets. And you can see it just goes on and on and on. And it kept going back and forth so much, we actually just stopped. I mean, even since January's numbers were released, we have the Silicon Valley Bank issue and plenty more on that side, but we also have some really good news. So I'm going to share a bit of both of those. Before I move on though, I thought something like hot off the press, this is old school, just paper. I'm going to read off to you. I'm part of the Dallas Federal Reserve Bank has a survey that they do every month. And I'll share this with Laura to reshare with everyone else. The reason I'm sharing it, there's a section when we fill it out. The way it works is the Dallas Fed sends us this survey. It asks things like, are your revenues up or down more than you expected from last month? And where do you think they'll be 6 months from now? So it's a little bit of a sentiment analysis, but what I find really helpful and interesting, there's a comments page where business leaders like myself and you all will talk more specifically about some of the challenges that they're dealing with. I'll send you that link. I think it's really helpful to go through, and you'll see on either side of the equation. I'll read off just a few for you verbatim, just so you have an understanding of what other people like you are feeling, because some of them will be all on the top side of this page where they're not feeling that much of an impact. Others are the completely opposite side, and I'll start actually there. So this is, again, it was just released this morning. So one business leader says, we've had 2 full months with minimal to no new contracts signed. March has finally seen some client signatures, but we're still way below what we expected for March. Another one on that side of the equation said, we just had our worst month since the Great Recession. So we're talking going back more than a decade. We are down in every way you might measure: dollars, hours billed, proposals closed, proposals written, and so on. So there are some of you I know on the line right now that are feeling that type of market. I bet there are also others that have more of these comments. I'll read 2 others. We do not see any evidence of a so-called imminent or pending recession or an economic downturn. The only trouble we're having is hiring and retaining qualified staff. Seeing no impact. Another, people are spending money. We do not see a recession. So I'll go through this presentation. Just know that there are some of you that, as I say, some things you might totally relate to, and others are experiencing something different. You might have heard of this phrase, a rolling recession, and I believe that's likely what we're more in right now. There are certain segments that are getting hit, and they might come out of it earlier than other segments or other industries that might get hit a little bit later, and some might go through this whole thing and not feel much of a speed bump at all. So I'll talk through all of that as we go along. But before I do, I just read a bit of news there and some headlines. So let's start with, before I cover some really good labor market numbers we've had earlier this year, let's start with what's driving some of that sentiment. So heading into the year, we still don't have the talent back. Now, our labor force is larger than it was before the pandemic finally, but we're not where we would have been without it. We're still probably a couple million people short of the number of employees the US would have to be employed if the pandemic did not happen. So we're still struggling with some really low unemployment rates. That's then leading to wage growth that has been off the charts for many many companies. I'll cover that, especially later in the presentation. Everyone on this line, your companies, you as consumers, your friends, family, we've been dealing with inflation and interest rates from a variety of angles. From that whole finance side of the equation, that very last bullet was just added to this over the last couple of weeks. So recent issues with banking has added to more economic uncertainty. As you read through the comments of that report I referenced, you'll see a lot of those in there because it was taken right after the Silicon Valley Bank incident, if you want to call it that. We, by the way, are customers of Silicon Valley Bank. So a little bit of a unnerving ride. Everything's fine with us, but we felt that firsthand. And then finally, layoffs, whether you as a company are experiencing it, whether you're contemplating it, whether you're seeing it in the news headlines, it's certainly having an impact overall on morale and sentiment of businesses. But with all that, those are some of the feelings. And if you looked at LinkedIn at the top, you'll see some really negative stuff sometimes. But if we look at the actual numbers, they've been phenomenal in terms of at least what we're seeing in terms of the labor market itself. So here's the recap of just the first couple months of the year. We'll get a new report, I believe next Friday. So not this Friday, but next Friday. So far, through the first 2 months of the year, employers around the country added 815,000 new jobs on top of any jobs they replaced. So I want to make sure when people see those numbers, what they mean, what they represent. You see a lot of layoffs. When you see a positive 815K, it means on net, all those layoffs were covered by another job, plus an additional 800,000 on top of that. Really phenomenal news. And I will tell you, as we were forecasting last fall, I'll show you our forecast here in a minute, this is well beyond what we expected. I think what's challenging is, from a business and business leader standpoint, you're creating budgets, depending on when your fiscal year ends and so on. But last fall and early winter, you're finalizing budgets with such an unknown world in 2023. I would say overall, what we're seeing, as I've mentioned there, businesses on a net basis still have confidence to not just backfill roles, but add new ones on top of it. That pace, about double what we had seen through the first 2 months of a year. The unemployment rate, I'll give you more historical perspective on this. Just know that 3.6% is one of the lowest we've seen in the last 70 years. If you're searching for talent, it might be a little easier now because of layoffs. There will be people who wouldn't have been out there looking for a job. You'll get some more candidates that way. But it's still a very, very tight labor force. And then overall, we are seeing wage growth moderate a little bit, but 4.6% is, I'm sure, well beyond what most of you are used to in terms of when you're going through your headcount budgeting process for the next year. I'll break that down later in the presentation and show you between people who stay in their jobs and who switch their jobs, what the difference in premiums we're seeing in terms of wage growth from that perspective. But from a macro, point of view, I'll stop here just to see overall if there are any questions, comments, anything before I move on to the less fun topic of interest rates and layoffs. So I'll pause this for a second and see. I don't see anything on there yet. So if you have anything, just feel free to enter it. I'll keep on rolling with the presentation though. So interest rates and layoffs, let's go ahead and jump into it. These are some of the core numbers that we follow, and there are more out there, but these are some of the core ones that we follow that we know the Fed also watches in terms of inflation indicators and whether they are changing or not. Now, I'll tell you, as we put this type of material together, over the last, I would say 6 to 12 months, inflation really started ramping up around this time last year into summertime. Since then is when it started to moderate. We have had to change our language a little bit when we describe this because it's not just when will inflation slow, it's slowing now. You just might not feel it every day when you go out and you go to buy something. It's like, gosh, I remember when it was half that price or what seemed like half that price. But these are some of the main indicators. I would say for you all as business leaders, the one that is probably resonating a little bit, at least I hope you're starting to see some of it, is that middle chart. And I don't know if you're as familiar with it as you are the others. So the consumer price index, that's as we go to buy goods or we pay our rent or car loans or any of that, that's measuring as from consumers, how much we're seeing prices go up. And it's moderating down. Just the Fed would like to see it at probably half the rate that it's at, 6%. So we'll see if it comes down some more the rest of the year. You're very familiar with wage growth as you go to set budgets for your staff and so on. That ticked up slightly, but there's better news there than you might realize. If you really dig deep in the numbers, this past February had the second lowest sequential gain in the last 23 months. So you'd have to dig really deep to find some good news, but we do think that that number will start to moderate. But let's focus on the one in the middle. So the producer price index is when we all go to buy goods and services to produce our products, what kind of price increases are we bearing when we go to do that? And that number has fallen pretty significantly over the last several months. So it's down to 4.6%. I would say of all of them, it's the one that gives us more faith that we're starting to see some of these inflation control measures through rising interest rates actually starting to slow down the price of how much we're having to pay one year after next to produce the things that we produce in our businesses. Now, you've seen interest rates rise quickly. I'll put it more in like a personal level perspective here in just a second for somebody who's about to put their house on the market. Don't ask me why. I study this stuff. I shouldn't be doing it, but that's a topic for another presentation. But if we just look at interest rates and what they've done, what we did is plot out and thank you, LinkedIn. There are all sorts of people who put great visuals on there. This is one that we borrowed from somebody that I thought really resonated. What it looks at is over the last, let's see, 5 or so times that interest rates have been increased, how quickly were they increased and by how much? The whole point that you can see is that 2022 was in an extremely fast pace. We just added on the latest one that was announced last week. And so you can see this is much higher increase or in terms of absolute, percentage points and how much faster. The last comparable that we really had where it increased this much was back when it started in 2004. You might remember the subprime lending crisis that happened back then where, the rates were so low, everyone didn't matter if you had a job or what, you could go get a loan for a house and it was a fairly low rate by historical standards. It took, twice as long to increase rates to the level that we've seen recently. And so this has had a big disruption. And obviously this is why you've seen some of the news, this is part of the reason, some of the news of banks having challenges out there. The other thing I would say though, know that as business leaders, your employees are also facing impacts of this. What it costs them to get a home loan and the type of house they can afford. If they can sell their house, given what premium they might give up, any sort of credit card payments that they have or any other type of debt, this is putting extra weight on them to balance their monthly budget. So it's not necessarily anything you can do specifically about at all times, but just know it's something out there that it's going to be weighing on employees. Now, this is what I meant from a personal level that many of you can likely relate to. What we decided to do is just open up Zillow and figure out, well, back when rates were this, what could I afford and what if they were the rates now? So we chose $470,000 for the home price. That might sound really low or really high, depending on which part of the country you are located. We pulled that number because from HUD, Housing and Urban Development, that was a recent number that they had published. And so we just stuck with that. And we said, okay, if you wanted to use their number, 470,000, use an interest rate that's around, the interest rates have been bouncing all around. They've been above this, below this recently. I just stuck with that rate. People are balancing their monthly budgets. And so they're not just worried about that top price, they're worried from month to month, what is it costing me to get that house? So for what it would cost them, given some of the typical assumptions you see on the left, about $3,300 a month, give or take. What would similar monthly budget have bought you a year or two ago? So back when it was a 3% interest rate, to get roughly around the same monthly price, you're looking at a house you could have afforded that was $750,000. So what has that done? Completely changed the impact, the mortgage industry, how it's been slowed down. Anybody related to housing, I'll show you industry impacts here in a second. Obviously, anything related to housing is grinding to a halt or something close to that. Not completely shut off, but depending on which source you look at, one of them showed it was the first time housing prices have decreased in 11 years. Another one, different Case-Shiller's index is a little bit different than that. They just showed, I think, housing prices have dropped 7 consecutive months. On and on and on. But it doesn't just impact real estate brokers and so on. It's also the stores that supply materials to build and maintain, those types of products. So the other one that I look at from now that I'm, when I was on the real estate side, I still look at it from that angle. But, here in Texas, we thrive off of people moving to our state, relocating, moving here. If I just think of whether it's Texas or somewhere else, someone's ability to relocate. Right now, they're having to look at the price they paid for their house over the last couple of years. And by the way, I presented last fall at a conference. It was full, a couple hundred people who were in recruiting. And I asked the question, I said, how many of you bought a house over the last 2 years? And my hand was up along with them. I'm telling you, it felt like the entire room, their hand went up. Lots and lots of people over the last couple of years took advantage of low interest rates. They saw housing prices rising. They took it while they could. That market has completely changed. So what I worry about for people relying on relocations, it might be hard if that involves them selling their house at this point. So take all that, wrap it up. So which types of industries today are we actually not just seeing lose momentum, but they have lost jobs at least year over year? You see the ones over on the left. These are some of the companies. Remember when I read some of the negative comments, when you see that Dallas Fed, the comment section, folks tied to real estate, it's a bit different, tougher world, even though the last couple of years was phenomenal. Especially if you're on the single family side, that's where we see a lot of the impact. So you see there, building material supply stores, homes, home furniture, insurance carriers, and so on. So these are some of the ones that right now are figuring out they were some of the strongest out of the gate after the pandemic, and some of the strongest industries, types of jobs, and so on are now some of the ones that are struggling a bit more than others. On the other side of the equation, so where do we still, and by the way, there's a lot in the middle that is still very good news, but in terms of which ones are now, actually, a lot of these are kind of later to the party. They really struggled following the pandemic. It was hard for them to find labor, to keep up with wages. Not that any of that's necessarily changed, but it's a little bit easier than it was back then. These are some of the ones adding on a relative basis, some of the largest number of jobs year over year. Many in hospitality, trade shows that finally came back in person, and so on. So those are the ones on the good side. And as I mentioned, a lot in the middle are actually pretty positive. From layoffs, I'll tell you that I guess I've tried throughout my career not just to focus on the main story that everybody knows of, but also add perspective when it seems like the headlines don't really capture everything that's happening out there. And again, depending on you and your business and your location, you could be experiencing different things. But what I try to remind people that layoffs have been at historic lows the last 2 years. Just reverting back to the normal average, which is what we're doing right now, will seem pretty dramatic. And in some companies, there's no doubt that it is. But this is our forecast for the year. So far, it seems like it's holding up. We're basically getting back to levels we were before. You tend to see layoffs a bit more concentrated. So, if you've visited layoffs.fyi, it's a site that I frequent just to see some of the latest news. You can actually find candidates that were impacted on that site. So if you're looking for a great software developer, like most of us, and we couldn't find any over the last few years because a lot of really large companies were able to gobble them up at salaries that were at the pretty top end of the bell curve. You actually see candidate names on there that you could get in contact with. But you see these news stories of 20% or 30% of more. Just know that on a month-to-month basis, layoffs are only, this number is about a 1 to 2% impact of U.S. employment per month. And that's back to typical levels that we've seen in the past. There are a lot of employers who haven't been able to hire at volumes the last couple of years, and they are starting to benefit from some of this. I don't know if you saw the Wall Street Journal article towards the end of last year. ZipRecruiter put out some stats based on a bunch of surveys that they did. And I don't remember all the specifics, but it was something around the all industry average. I think something like half of people impacted by layoffs found a job within a month, and 83% within 3 months. Again, if you go to my LinkedIn page, look at some of my posts, I have one of them recently related to that news story that was on there. So this is where the headlines don't exactly represent everything that's happening out there in the economy. So one of the things that we follow are the unemployment insurance claims numbers. They're still very low compared to historic standards. So most businesses are actually still in, everything I've seen, hiring mode as opposed to layoffs. That's not the balance of what you see in the news stories. Pause there. See any questions that you all have about some of those other negative sorts of impacts. So question that we did have based on one of the last ones is, I had businesses have confidence to add new roles. There is a question of, can a bubble form? My response to that is, I think a bubble formed over the last couple of years, that if you look at some of the really large companies that are announcing fairly large layoff numbers, some of them hired tens of thousands, hundreds of thousands of employees over the last couple of years. and now some of them are being impacted by layoffs. So I feel like there was more of a bubble there, and more of a bubble, as I'll show you towards the end of the presentation, at the what I would call the top end of the bell curve. So salaries for people that didn't really have the experience you would expect, all of a sudden getting 20, 30, 50% raises, because some firms were so desperate to hire to hit their production goals, they paid much more than I would expect for that talent. I'll tell you, I've seen that from a personal level as I've gone through just from a professional over the last couple of years. Another question we got, so layoff headlines making my job harder. Search clients looking for executive candidates expect to have much bigger pool of available talent. So one thing that I'll mention to you, you will see some more people hit the market and be looking. Just know that management and executive roles, I think I actually have this on one of the slides coming up, tend to have one of the lowest unemployment rates of anyone out there. We saw, a big theme we saw right after the pandemic, right as the pandemic unfolded, and we saw tons of job loss. We tended to see companies try to hang on to their more experienced people, because when they get to the other side of this, they need those folks ready to go, hit the gas pedal and keep going, as opposed to all of a sudden now out in the market trying to find somebody to do that. Don't be surprised if you see a similar type thing play out. No, you're likely not going to see tons and tons of executives on the street looking for jobs. You will see some, though. Thank you again for that question. All right, so hiring, which is really where we focus. We focus more on the churn in the labor market, not just the net new jobs, but the churn. And I'm going to show you for the average business in the US, what that looks like for this year and how that relates to last year. Before I do that, though, let's talk about the overall scenarios that we were expecting. We're getting ready to revise this now that we've got a little bit more information on this year's market. We're probably going to raise the number, top number on the left a little bit. But this is the outlook that we had heading into the year. And I'll tell you, both scenarios I'm about to present, either one of them could happen. So when we were formulating this last fall, we kept evaluating it month after month. We did not change our scenario. We thought either one of these, could happen. From an optimistic standpoint, which was actually our base case scenario, we still had 1.2 million new jobs being added to the market. So again, that means layoffs are covered one way or another, and you add an additional 1.2 million jobs on top of that. I showed you on the first main slide, we've already added more than 800,000 this year. We're already 2/3 of the way to that number just through February. So it looks like it could blow it out of the water. Just know that that number can change quickly and go negative fast. So I think we'll likely raise this number up. I would say that we've seen more confidence from businesses this year. Heading into the year, the Wall Street Journal surveyed 60+ economists, and they range between 4 million jobs added and 4 million jobs lost. Most were between +2 and -2. Just know that expectations for this year have been all over the board. From an optimistic side, that's the number that we had. Again, what it would mean is even with interest rates hikes, they start to kind of moderate. Businesses are able to handle everything. We don't have more bank issues, and the ones we have get taken care of. And people are basically confident to keep moving, and inflation does get under control enough, and we just keep moving. This is the soft landing scenario that you hear about. A more of a pessimistic outlook would mean we would lose 620,000 jobs. So from right now, what that would mean is we would need to lose basically 1.4 million jobs the rest of this year for that to happen. Probably not the case. Let's hope not, but you never know. It could. Here, this would be if you kept seeing more bank issues, if you, and not just you, but your customers started to become, a little less hesitant than even they are right now. I would say one of the biggest things, I'll present this here in a second, it's your time to backfill roles. If you're not immediately, as soon as, if somebody voluntarily leaves, if you're not right then opening up that job rec, you're saying, well, let's pause and let's wait. If more of that occurs than what we've seen so far, then I would be concerned that this is more of a likelihood. But right now, it looks like the situation on the left is more likely than the one on the right. I saw in the news this morning, harsher outlooks. I would say that overall, from what I've seen, others present, what we've presented and others as well. If something does happen, it's expected to be fairly short-lived, and we'll be in positive job gain or job growth scenario, by early next year, even if things worsen from where we are today. Now, what I mentioned is, especially, and I would think about this from an operations standpoint, it's not just about the handful of jobs you might add that you didn't already have. It's, hey, let's add a few more sales roles or customer support roles or whatever it is. It's those plus all the extra churn and hiring that your teams have to work through throughout the year. So starting with job openings over on the left, if you've seen any of the headlines around this, more jobs open than we've ever seen. That number is starting to moderate down a bit. If you sum up all the months, last year there were 134 million jobs open. Our workforce is barely above that. So many jobs open, you can't fill all the roles. Sometimes people, I've even had one of these. I had a data science role open. I wasn't sure exactly which one, so I opened 2 or 3 at different levels and different types of, was it really data scientist or an analyst? And so sometimes companies will do that. They'll inflate it, and out of those, they might make 1 hire and not 2 or 3. The ultimate number we look at is what's in the middle, because this is what your teams will be going through in terms of how busy they are bringing people on board. Last year, at record type levels, 77 million total hires in the US. This year, we're projecting about 69 million, still above the average we saw right before the pandemic, but just know your teams will likely still be busy. Voluntary quits, thankfully, hopefully, will be down from the record levels of what we saw last year. Part of that has to do with just general sentiment. So what I thought I would do is put these numbers into perspective and what it might mean for you and your companies, and more of a visual aspect instead of just numbers on the page. So what we decided to do is just go through a simulation where, what if we said, okay, it's a 1,000-person company, and each person on here represents 10 people. What does that churn and job additions and so on, what will it probably look like throughout 2023? So if we're on that positive side of the equation, then you might add 1 to 2% total headcount to your company if we take all companies that are out there in the US. So if you're a 1,000-person company, you might add 10 to 20. The role might exist, but you're expanding how many people you have in the role. Or it could be a brand new department or a brand new role that you did not have before. So 1,000-person company, 10 to 20 new employees. But I'll tell you, again, we're in the compensation space, and I'll tell you, as our sales team are having conversations, sometimes we'll hear things like, well, we're not hiring this year, which is false for almost every company, not every company, because you have to backfill roles, whether it's involuntary or voluntary turnover. There's a lot more hiring that occurs in a company than I think a lot of people realize. So let's start with the involuntary turnover. So we're expecting, so these are all industry averages. When you see some of these, you might think, oh my goodness, we're way below that. Thankfully, some of you might have something a bit higher. So we're projecting roughly about 14% involuntary turnover this year. Some of that will be more in the form of layoffs that did not occur. Last year, the last couple of years, it was more in terms of just terminations, because for one reason or another, the person just did not work out in their role, no matter everything that the company and the employee tried to do to remedy the situation. So that's up a little bit from what we've seen in the last couple of years, because again, layoffs were not as in play as much the last 2 years. You then look at voluntary turnover, which had been record levels at a national level, kind of in the low to mid 30% range of voluntary turnover. So roughly a third just leaving on their own. Variety of reasons why: flexibility, compensation, career progression. There are a number of things that lead to that. But that number we have edging down to about 28% this year. So again, for a company, an average company with 1,000 people, there will be 280 positions your folks will have to hire just to refill the roles that were already there. And then obviously you have the rest that you are trying to retain to not end up in one of the buckets you see at the top side of the page. So this is what it looks like compared to last year. Again, subtle nuances, and this is assuming that, again, voluntary turnover declines. We don't add quite as many jobs as we did a year ago. So you'll see a few less green people up here. The main thing, and this is what we'll be watching as we study the labor market and how that relates to employee engagement, turnover, compensation, and so on. The folks we have here that aren't filled in, and that's the represent, are you actually backfilling those roles or not? Are you backfilling those as quickly as you normally would or not? I think that's something that we'll see that could be a bit different than what we witnessed over the last 2 years. So again, 2 sections left. I'll pause here again to see any questions anyone has around any of those hiring or turnover statistics. Not seeing any now. Feel free to continue to add them. I can cover them later if there's something else that you think of along the way. So let's talk about talent availability. We had a question earlier around, gosh, my team thinks that we should be able to hire these, whether it's directors or VPs or executives or really anybody, any easier than the last 2 years. I would say, as a hiring manager, the thing that I've seen a lot and my colleagues that we've seen more often, I'd say two things. Just layoffs, and some people that are have recently been impacted, and we're seeing more candidate flow from that we did not see over the last 2 years. The other thing that we've seen has to do with return to office, and some companies that are having return to office, we're hybrid, by the way. We're Monday through Wednesday in the office, Thursday, Friday work remote, or you have the option to come in if you would like. Where we're seeing it more so though would be candidates that took a job or employees that took a job elsewhere. So we had one that was employed by somebody in New York. They probably got a deal hiring someone in Texas, but now they want everyone back in the office, and he was not willing to relocate. We've seen multiple versions of those. So two things there at play that could influence some of the candidates that you see or your team sees coming through the pipeline. Did get a question here on, so normal rate of voluntary turnover is 28%. That sounds high. Our voluntary turnover rate last year was about 11%. So I agree with you. I would say for our company and for companies who really focus on the employee experience and so on, that plays a major role. Industry also plays a major role. Again, I was in the apartment industry, worked directly for an apartment company. On-site turnover versus corporate office turnover, even within the same company, massively different. I will say if you check typical professional office jobs though, it probably is higher than you might expect, and it might be higher at certain positions or in certain locations. But again, industry factor and size of company and so on, there are a lot of things that can really impact how that overall number looks. But yes, good point. That's one of the reasons I mentioned you might see that number and it sounds way higher. It could sound way low. I've seen in some cases it could be 50% depending on the type of job. So let's look now at talent availability. Overall, I just mentioned, so unemployment rate, the latest one that came out was 3.6%. The month before that was 3.4. That tied the lowest that we've seen in the last 70 years. I'll cover that on the next slide. But just in terms of, one of the bullets for this session was to talk about types of jobs and which types of jobs is it still really hard. I would say most jobs, almost all jobs. I don't know anybody who's found it very easy to hire anytime recently, but these are some of the overall by broad occupation types. So tech jobs, even with all the layoffs you see, tech jobs still at 2.2% unemployment rate. The software developers and data scientists and so on that are being impacted are finding jobs pretty quickly. The others I mentioned, management, so that includes executive level, 2% for someone who's management level or above. Typically, as we would say, to your best ability to find a manager is going to be find somebody who's not a manager yet, who's ready to be promoted. And obviously there's a learning curve there, but that's more likely to find somebody where you don't have a significant shortage of supply. You can actually find more candidates that way. You see the others, legal, obviously healthcare roles remain very, very high in demand. This is what it looks like from a more historic perspective. And so if this is a visual that we have in our tool to give people for any sort of job in any market, what the relative supply looks like. If we went all the way back, the last time it was really lower than now was 1953. So anyone that's under the age of 70 in their life has never experienced a labor market this tight. You've got to go, anyone who's maybe mid to late 80s and above, they're the only ones who've actually worked in a labor market this tight. And so this is not what anyone is used to experiencing. And this is what it looks like over time. So again, last time was in May of 1969. The last time we really had inflation issues, the way that we have them now, was back in the late 70s and early 80s. And back then, unemployment, instead of being at these numbers and continuing to decline, they shot up to 10.8%. So much different market and different dynamics than what we saw the last time we had a significant inflation event. The long-term average is right about 5.5%. We saw that right before and a little bit after the Great Recession, and then you see where we are today. So a challenge that we have, I referenced this, and what's driving some of business sentiment as you and your employees are trying to hire people to fill roles. we just don't have as many people as we would have if the pandemic never happened. If you start to break down, so we've gone through this exercise of, well, who are we missing and where are we missing and so on. I would say number one, know that if you are in markets in the Southeast, Southwest, or maybe Midwest, or no, I'm sorry, not Midwest, Mountain West, you're likely experiencing something a bit different because of population movements, where we've seen a lot of people move from the coast or the Midwest to some of the areas that I just mentioned. On top of that, so there's a geographic difference. On top of that, we're missing likely somewhere around 1 million or more immigrants, people who would have moved here without the pandemic that would have helped in agriculture and manufacturing and tech and healthcare, and name your industry, it's having an impact everywhere. The other place that we're seeing it, and we're seeing it in multiple, but the other one that I would mention would be with women. That women, with the very latest numbers that just were released over the last month or so, just got back to the labor force participation that they had, or at least the level of right before the pandemic. So now we have roughly, I think, 100,000 more women in the labor force than we did before the pandemic. Terrific news. So that difference you see there of about 1.7-ish or so, 1.7, 1.8 million more people in the labor force, it's almost all men. So we're still missing, more than 500,000 women and all the people that normally would have immigrated here, some other groups as well. And so, but without the pandemic, we likely would have been about 2 million or so more people in the labor force today, which would influence some of the unemployment rate and other numbers that you see. All right, so this is the part where if you don't think I've gotten real nerdy on economic stats so far, thank you, but this is where it'll probably change. This is something I used to love to look at right as the Great Recession was playing out. We were on the other side of it. We brought this chart back and revived it about a decade later to look at how jobs were recovering from the pandemic, what the impact was like. But next, I'm going to show you industry, and this is where it really starts to break down of differences we're seeing over the last couple of years, but then to think about what we might see over the next 12 or 24 months as we experience another just round of disruptions. So what we have plotted here would be, we look back at the last four, if you want to call them recessions, downturns, labor market impacts, whatever phrase you'd like to use, from the time that job loss really began, or when the recession started, how many jobs were lost on a relative basis? How long did it take, a number of months going across the screen, to get back to the employment level we were at before the economic disruption happened? And then I'll break this down by industry. So we can see here that when the pandemic hit, we lost roughly 15%. So about 1 out of every 7 jobs just went away within a matter of weeks. So just look at how fast it took. So the Great Recession took 2 years. That gray line you see, notice on the page, it took 2 years until we actually hit bottom and stopped losing jobs from the Great Recession. This time it happened overnight. And then we started recovering fairly quickly, but a much, much deeper hole to climb out of. So notice we dropped multiples more than the past few recessions, but recovered all the jobs faster. Because of that, and what it took from different sort of incentives, financial boosts to get money in people's pockets, keeping interest rates low, all of that, we're now dealing with the other side of that now, as well as just how quickly. So we had the question about the bubble earlier. It's really hard to make this happen without some sort of impact to pay back down the road. So we're starting to go through that now. We just couldn't maintain this trajectory, and we're starting to see obviously certain industries, certain types of jobs being lost. This is what it looked like if you take all industries. I'll give you a couple slides next of if you start to break down individual ones and which ones might be a bit more resilient, because they tend to be no matter what. So let's start here. These are some of the different industries if we compare them over the last few recessions. So let's start with construction. Remember, if I go back one slide, with the Great Recession, we only lost about 6% overall of employment. Construction lost more than 25% of employment during the Great Recession because of what it did to housing. And you can see how it took all the way to the end to actually gain all of that employment back. This time, within basically a couple years, construction had gained back because of how strong the housing market and others were. So it was impacted much differently this time than the Great Recession. It was much more resilient this time around. Tech jobs. Compare professional and tech jobs in their timing Great Recession, you're looking at more than 130 months to add back all construction jobs. Professional and tech jobs, it was less than 4 years. This time, right around 1 year actually during the pandemic to make it all up. Finance, banks are being impacted now. Look at finance during past cycles. So again, back here, this was the lending, and it didn't have the dip that construction did, but took longer. Finance was the first one to add all the jobs back for a lot of different reasons. In past economic downturns, it actually grew. They grew despite the fact that we were in a recession. Next one, so these are some of the ones that I find really interesting, likely to hold in better and stronger than some other types of businesses. So if you're in one of these, thumbs up to you. If you sell to one of these, thumbs up to you as well. If not, we can just all wish that our industries were like these guys. So education, notice that education and healthcare both on the left side of the screen, it does not matter what happens other than the pandemic when doors literally had to close. And so on-site staff, people maintaining the buildings within these types of establishments, just certain things where the jobs on site might have went away, but those that could be done remotely hung in there and they were able to add. But notice you go back the last 3 recessions besides that, and they kept on adding jobs. So again, if you're a service provider or you sell into these industries, that can be a good thing for you all. On the right side of the page, government tends to be a bit more stable because they have the tax revenues rolling in that we all have to pay, even if the economy is going down, I still have to pay my real estate taxes. On the top right, the hospitality industry was just decimated in the early days of the pandemic. It's made a strong comeback over the last couple of years. Again, if you serve that industry, something that I find interesting about it, it actually doesn't get impacted during recessions as much as people might think. You'll see more staycations where instead of going to, Europe or the Caribbean or somewhere like that, people might do a staycation, they go somewhere here and it benefits our local hospitality industry. Even when times are bad, you like to find ways to go out and celebrate with your friends. So that industry, which had a really tough time over the last couple of years, I think it'll do better relative to some others this year. From an overall standpoint, just a few notes that I have. I mentioned 68, 69 million hires for this year. These are the really big industries in our company or in our country. They're going to add about 75% of those jobs that are out there. Professional and business. So I feel like small to medium-sized businesses that just haven't been able to hire and compete on compensation, but they have the budget. Those might be some types of companies that benefit from some of the layoffs and disruption we're seeing in the market. Now, that's not going to be the case for all SMBs, but for those that are out there that still have that budget, I think they could be in good shape this year. Healthcare, you just saw the slide, they tend to go up no matter what. And with an aging population, there's going to be healthcare demand continued. With trade, I would say, particularly with retail trade, some of the recent news headlines that have been out, the SNAP cards that have provided an extra $200 worth of ability to buy things like groceries over the last couple of years, those benefits have started to go away. They were some of the last remaining really economic boosts that consumers were getting. That is starting to have an impact on retail, but I would say overall retail likely to hang in there okay, but some will be impacted. And I just covered leisure and hospitality as well. So a couple more, and then I do see I have a couple questions, so feel free to load those up before I get to the next break. This is what it looks like from an overall standpoint in terms of monthly job gains. I like to remind people that the little orange bar at the top, that's our optimistic scenario. The bottom is the more pessimistic. It's looking like the possibility that upside could be where we land, or perhaps even above that. It's running well above that pace right now. But just compare what we've seen the last 2 years to the last 20 or so before that. Completely unsustainable pace. So just know that as we moderate back, there will be some pain, but you'll see that more of those numbers return normal this year. And I'm hoping 2024 is more of we get on the other side of it and things do really become a bit more normal next year. So before I wrap up with the final section that I have here today, I'll see what questions we have. So we have a question on how is the market supply impacted by labor force participation? So that has to do with what percentage of people in a certain demographic are participating in the labor force. Also there on demographics, so baby boomers versus Gen X so on. I didn't have those stats prepared specifically. It is a factor that works its way into this equation. We have seen participation rates increasing. That's why you've seen that big bump in the labor force overall. Some of our biggest challenges really relate to, so it's more, as I covered earlier, it would be participation from women, actually participation from white Caucasian. So that 1.7 million number that we've seen up, that's almost completely non-white population that makes up the increase in the labor force that we've seen over the last couple years. And then immigration are some of the factors that are really playing a role in that. Next one, let's see. Surprised to see healthcare unemployment remain so low. Have several CEOs expressing challenges with their turnover of their doctors. Yes, I would say one of the things that might have been on that slide that where I didn't go as deep on healthcare, but when we speak with our clients and so on, healthcare. So if I look at who's using our product, the top three are kind of general HR and ops roles, tech, healthcare, and we see a lot of others, manufacturing. But we do have a lot of clients in healthcare, and I would say that burnout in healthcare is a major issue that we're seeing right now. So sometimes it depends on the role, but sometimes what you can see is people just drop out and they just leave the labor force either temporarily or permanently. And that's just one of the challenges that I think that role sees. The other challenge with healthcare, and the reason it's going to remain low, is because the demand for healthcare jobs is so high, which is causing some of the burnout, that's going to be a real challenge when we get a few years down the road. I was asked on a recent panel, one of the wrap-up calls, where 5 years from now, what are you thinking? What are you projecting? Had a variety of answers, but one of them had to do with overall labor force. I think it's going to be very tough for us to continue to increase our labor force with the demand. We're going to need a whole lot of Chat GPT help to help with some of our jobs so we can keep producing based on the demand. But healthcare is where I really expect to see the squeeze over the next few years. I've seen estimates like we have a 2 million shortage of nurses ahead of us, and we've got to figure out somehow to resurrect or to figure out that problem. Education, yeah, education supported by taxes. That's one of the reasons that you tend to see education. Interestingly, the thing is we do have fewer school children today than we did before. And so there could actually be a little less demand, at least in the school age, if you looked at any of our demographic totals, but then we have teachers retiring as well. Do nonprofits follow trend of government recoveries? Good question. I would say that nonprofits, we do have a number of nonprofit clients. I don't know what's challenging about nonprofits is instead of being an industry and really easy to get those types of metrics, it's a tax classification. So it can be hard to figure out. The thing I can tell you about nonprofits that we've seen from our clients the most over the last couple of years has been the struggle to keep up with wages because of their nonprofit status and the way that their funding works and so on. It's just difficult to pay what you see elsewhere in the market. Now, nonprofits vary. Some nonprofits actually pay higher than market average. There are nonprofit education institutions, as an example. Healthcare can fit into that role as well, but many of if I describe where we've seen pain in the market from our client base, nonprofits keeping up with wages, and even government, I would say keeping up with wages over the last couple of years has been a real challenge, just to find and retain talent. One more question. So much of the presentation is returning to normal as we see things moderate back. What changes will persist as new normals? So I think a shortage, as I've mentioned, alluded to just a second ago, a shortage of talent, I think, is going to persist for quite a while. I worry about what that continues to do to wage inflation and maybe broader inflation. I think it's just going to be hard. Even if we start to lose jobs, there's still demand out there for it. I think we're going to be in a labor shortage for some period of time unless we do something significant on the immigration front. Unfortunately, when you bring up the topic of immigration, it becomes political. I look at it as algebra. We don't have enough people. Where do we get more people when we see that, birth rates from decades ago were lower? And so I did my part, by the way. I had 3 kids. I've more than replaced myself, but generally people had fewer kids. And so the number of young people, we just don't have enough to replace the people that are retiring. I believe we have something like, I'm pretty close on this number. I think it's between 20 and 22 million workers that are aged 60 and above. Half of those are between 60 and 64. So 5 years from now, we're going to have roughly 11 million or so people that will have crossed between, on the other side of that 65-year-old boundary, and retirements. I have concerns with that. So those are some of the things that I worry about. The other that I would mention, new normals in terms of remote or hybrid work. I didn't cover that as much in the slides today, but there's been a lot of news about that. It depends on the source that you reference. They tend to show different numbers. So if you use the Bureau of Labor Statistics stats, they show that only about, it seems like everyone's remote. They show that only about 10% of jobs in the country are fully remote jobs. That's not the sentiment that it feels like. I saw something that referenced LinkedIn today that was a much higher number than that. I would say generally, though, that number is settling in lower, but there will, I believe, be more companies that are either hybrid or fully remote relative to what we've had. Some of that has to do with technology. Some of that has to do with generational differences in decision makers. It's part of plenty of material that I've referenced out there as well. Yeah, another younger generation have less interest in having children. Does not bode well for any of our Social Security benefits. Yes. All right, let's wrap it up with this one last topic, then I'll see any remaining questions that we have. So in terms of overall compensation trends, this is the outlook that we have for wages. This is taking the Bureau of Labor Statistics annual averages, and we projected ours for 2023. So overall, instead of being at 2 or 3% year to year in terms of wage growth, back when I was in real estate, we equated this to, what rents could you charge, or for you and your products, what might you be able to charge? But 2 to 3% was fairly normal, and that might sound like a normal merit increase for a lot of you if you went back historically. That jumped a lot. So 2020, the last 3 years, it's been closer to 5%, so almost double what we saw before the pandemic. This year, we do think it will start to moderate down, but still be fairly elevated compared to, say, a decade ago. So roughly about 3.5% is what we're projecting at this point, but it could be a little bit lower than that, just depending on some factors and depending on if the economy actually worsens from here. Now, I, for a very long time, have liked to follow what the Atlanta Fed puts out. So that's one source that I just showed you. The Atlanta Fed uses that and some others, I believe. If you just Google Atlanta Fed wage tracker, they have some really interesting interactive graph. One of the ones I've enjoyed following the most was this one. The difference between what wage increases do people get if they stay at their jobs or if they switch jobs. So job switchers, the bolder line that you see, typically people have switched jobs, they make more money. If not, why did they switch jobs? They must have really not liked the place they were at before. That's not completely true, but oftentimes when somebody's going to switch, it does come with some sort of premium. And sometimes that's because it's a step up in responsibilities, job title, and so on. So not all that surprising, shouldn't be, but just look at how the numbers have changed. Look at the spike that we saw from kind of 2021 to now, 7.7%. I referenced one of the conferences I spoke at recently. This is over the last year or two a fun game that I like to play with people during live presentations. I'll say, okay, so whether you're a recruiter or you're a hiring manager or whatever you are, if you've seen somebody, either somebody you hired or somebody that left you or you placed, if you've seen somebody get a 10% increase, raise your hand. I'm telling you, entire room, be a couple hundred people, everyone's hand up in the air. I say, okay, keep it up. How about 20%? Most of the hands stay raised. Now keep going, 30, 50, even when you get to 100%, there's still a few people with their hands raised. And so we've just seen things jump incredibly over the last couple of years. On average, the estimate is 7.7%. I guarantee you everyone on this call has seen something bigger than that. On job stayers, 5.6%. I know for everyone on here as well, likely if that's the type of merit increase you had year over year, you're going to have to turn some dials somewhere else on that budget to figure out how you balance it if that's the type of increase that your entire employment base keeps seeing. So we think that that number will start to moderate. This number could lag a little bit from what we've seen, just from what you experience out there in the marketplace. So it'll start coming down faster than what they're able to pick up, I believe, but just know that the numbers have certainly shot up a lot over the last couple of years. We've also seen more in terms of pay transparency. Now, I don't know if you all have gone out and looked at some of the some of the job postings that have been out there in some of the states that have implemented pay transparency, and I'm sure we have some folks that are in some of those states. There was one bank that there was a job posting, the pay range between $0 and $2 million. And so I think it's a great effort for a lot of reasons, but the ranges tend to be very wide, sometimes legitimately, sometimes not. I'll show you that here in a second. So it isn't, it's more common, I would say, to see a job between $50,000 and $100,000, which is still a very wide difference, or 75 to 150. There are a lot of those out there. This is what we tend to see. So I'm going to cover a couple different topics on this visual. So we decided to take one type of tech role and look at how the ranges could really be legitimately based on what we would recommend out of our system for those roles, and how much they could range as you progress through levels. So these are all software type roles. We looked at 3 major tech hubs. I know Seattle and Boston were 2 of them. There's one more in the mix. So from a software developer, it could be between 105 and 166 base salary. So base salaries we're focused on. You see there for a manager, you then start to see once you get further up in executive pay, you start to get much wider depending on type of business, size of business, what their compensation structure, how much is in base salary versus variable comp, stuff you're familiar with. You see, so you can legitimately have wide ranges. Outside of pay transparency, different topic, same visual. Some of those bullets that you see down on the left. So as you're working with your team, and I'm sure you're already doing this, know a few things. One, if you're going to rehire the same role that somebody just left, know that the person walking in the door is never bringing the same exact attributes, experience, and so on as the person who just walked out the door. Candidates will bring different things to the table. So you could have somebody very seasoned that just left, and you're going to replace it with a role of somebody who's brand new or earlier in their career at that role. So just know that when you're working through that, you're not necessarily offering the same exact salary that the last person, that the last person had, or what different candidates might be commanding in today's market based, again, on some of the attributes around experience levels that they bring to the table. The other thing that we might remind people of is when that person leaves, do you need that same role? Is it a director or an executive type role, or do you need more of a production person to actually get the stuff done? Or do you need somebody on the right side who's really setting up the systems and monitoring and building those? And so just a couple of reminders that, as we think through some of these types of visuals of what resonates with us as we are either personally making these or we're advising clients. Just a few more things that I would show. So why else could pay range? This is just looking at data scientists in Boston, and based on a variety of factors, how you could see it from on the low end, 76,000, it'd be really hard to hire somebody at that rate. To the high end, you could be closer to 200,000 or above just in base salary. This is the trend that I expect that we will start to see more of this year relative to last year, and how that could change. Here's what I saw personally, and what I've heard a lot of people. That last year, if you had somebody that was, let's say, you're not far off from market, and maybe this person had a little bit less experience, they're hopping from this place on the bell curve all the way up here. And the question about the bubble being created, where I've seen and what I worried about over the last couple of years are when companies were so desperate to hire, particularly those with big budgets and cheap capital they could access, that they were hiring experience that did not justify the salary, or those that maybe were a little bit higher on the bell curve all of a sudden jump to the very top. So the difference of that sort of just this kind of cash grab for talent that we saw the last couple of years, this is what I expect to see more this year. That person that's right there, they're just slightly moving up. That's that smaller increase that's more normal that they would expect. The other thing would be the people that landed on that top side of the bell curve actually potentially taking a step back in pay if they're impacted by layoffs, and that market's just not there the way it was the last couple of years. Or they're willing at this point to give up some compensation to remain remote, either with their current company, probably not their current company, but likely for another company that's out there. I do think that's a trend that we'll see. The last couple of years, even if they were remote, you still got a premium even if you're remote. I think we could see a little bit of that move around this year. So summing up these points, we'll then take any remaining questions and let you have whatever time back in the day after that. So final thoughts, the economy, things were looking a bit more stable till we had some of the recent banking issues. I think the Fed's actions make, they're trying to say they believe it is not a widespread thing and that they're going to cover, at least for now, any of the challenges that we see. Hiring will remain elevated. So there are going to be a lot of companies still out there, but it will vary by industry. Same thing with turnover. Layoffs will increase, but again, more back in line with norms. Very competitive talent market. The thing that we'll all be watching, again, from a business and a personal aspect, when inflation will really get under control enough for the Fed to stop raising interest rates and potentially begin to lower them, and that will have a big impact all across the economy. So again, if you want to connect with me after this, the slides will be available. If you have any other questions for me later that we don't answer today, feel free to reach out to me, my colleague, the company overall. And with that, I will stop and answer any other questions that you have. And by the way, I do have a couple on here. Let's see. Cool. Yeah, just somebody let me know that they need to leave a little bit early. Any other questions from this fantastic group? And thanks for being engaged and asking questions along the way.
Jay, this is Dave Marston, Fort Lauderdale. Great presentation. Thank you on behalf of everybody. Question, pay transparency. When people are putting those huge ranges up, companies are putting up a range of $5 to $500,000 for the job. It's a pretty cynical way of complying with the law. Are they really just trying to be unhelpful, or is there something more to this, and do you expect it to change?
Yeah, good question, Dave. My feeling is things will change. I think this was an interim step to start to get there. When it's I would say a more of a production level, really straightforward job, you tend to see much tighter ranges. So if you are working for, like I'm sure anyone, what really changed over the last couple of years, I think we covered this in maybe the presentation I did before. A big change we saw from a transparency standpoint over the last couple of years was, take a Starbucks or somebody like that, you would walk up to their door. It's not just hiring now, it's hiring now and the wage posted right there. So those production type roles that you see tend to be, they might say 40 to 60,000 or $15 to $20, depending on a variety of things, experience and so on, where you can say there's some legitimacy, obviously not in the example I gave earlier or the one you just gave. It tends to be where I don't think they really necessarily either have their role defined, that's one, or if there is a much more variable comp portion of it. So say it could be 100K, but with bonuses, you're up to 135 or 140 or something like that. Now, when you're in the multi-$100,000 range, you're likely at a minimum talking about executives. My guess would be somehow, some way, those regulations get tightened up, coming up here in the places where they've been introduced. Did have a question from Paul. What are the breadth of services offered by your firm? When should we think of LaborIQ as a solution for our needs? Yeah, thank you for that question. We're really focused on a challenge that we've seen out in the marketplace is you can get a salary survey that tells you what everyone's already making. If you go and try to offer that, that's not really going to help you. You need to know what the real market is now. That's the main part of what we do. So as an example, if I use an accountant, if an accountant today made $70,000 on average, to land a new accountant, you might need to pay 75, or to retain one, you might need to pay 75. That's what we do by helping, again, job title, market, and education experience specific. That's our main role. We do have a lot of labor market stats as well, but people are using us. Our main feature is compensation recommendations. Thank you for that question. Question here, how do you see the contract worker trend working out in the long term? Good question. I'll tell you, that's from the tech perspective. There have been some articles written on that this week that, tech workers still charging $120 an hour from a contract basis because they've been able to pick up that type of work since this impact has happened. It depends on the business, and I think, do you expect it to be a long-term or a short-term? But generally speaking, with the more gig economy and the ease and ability to do that, I think long-term contract work is probably going to remain more elevated than we've seen in the past. A lot of the record number of job, business openings or business creation that we've seen, or people that with professional services. One of the reasons individuals like to do that is it gives them more flexibility. There's a report. If you search for a group called Achievers, they really got on my radar a couple years ago when they had some sort of stat that 60 or 70% of employees were considering switching their jobs this year. They got a lot of attention from that. They do these surveys. The numbers are lower now, but probably higher than you would expect. They looked at what causes an employee to stay in their current role or leave a role. Flexibility was like number one. And so compensation is usually up there, but flexibility. And that's why I think a lot of people, as from a longer term perspective, I could see contract work gaining more momentum than it has in the past.
Do you see fractional work becoming more prevalent?
I do, and sometimes it's because it can depend on before the businesses. Thanks for the question, Jeff. Before businesses are really either able or ready to commit to certain things. So, as an example, we're a small business. We've used fractional CFOs as an example in the past, and that's something we would continue to do until we get to the point where it made sense. I think anytime there's uncertainty, businesses are going to be looking for ways to alleviate risk. So either risk of the full purchase or not. So I mentioned I'm selling my home. The reason I'm not buying a home right now is not just because of what interest rates have done to the monthly price, but it's also the risk of what could happen to the housing market. And so I think businesses, when they think of either contract work or fractional work, will certainly be more interested in that over the next, I would say, year or two until things really steady. So another question we have: boss CEO is intrigued by the position Netflix has taken, pay premium based salaries with no variable bonus commission component to compensation. Thoughts on that? Yeah, I think it all depends on the business. Netflix tends to be out there compared to what most companies are usually able or willing to do, and so it's great to see firms like that try new and different things that a lot of companies don't. I don't know if it just depends on the business, and if they look at, from a profitability standpoint, if we're not profitable, then what happens? Are we in the position to lay off, or can we say, listen, we're just not paying as high of bonuses this year, and more of their employees will understand that. So I think there are different sides of the equation of how that can work out when the economic environment changes.
If that's it, Chuck, do you want to take it from here?
Sure. First off, thanks, Jay. I appreciate your time and the dedication to your craft so that you can help us all look smarter in our jobs. And we, quoting some of the data that you have, I think we would probably be the talk of the town at the next social party. So remember some of that data, folks. So again, thanks, Jay. Thanks everyone for joining us. I appreciate it. Thanks for taking the time out. Just a plug for a few things coming up. We have on April 25th, we've got Scott Dust from Cloverleaf presenting on co-leadership. That's a great topic that I'd recommend jumping in on. And then Thursday, May 4th, we have Ben Fu, who's going to be coming in to talk with us about the impact of AI on our businesses, which seems to be a lot of the rage these days. So we've got a couple great presenters lined up here in April and early May, and then obviously a calendar full beyond that. So would encourage all of you to come out again next month. Also, make sure you're getting out to your local forum meetings in your cities. So again, thank you all. Jay, thank you. Excellent. And we look forward to connecting with you in other ways as well. So
yeah, and I'll recap and send everybody the contact information, Jay's link and his deck, and a link to the recording as well. So I'll probably get that out in the morning.
yeah.
Thank you all.
Thanks, everybody, for
Super.
being here. Thank you, Jay.
Thanks, everyone. Thanks, Jay. Take care.
Thank you. Bye-bye.
Bye-bye.
Thank you.